since June this year, and I will try and take you through the essential elements of this law. What was the goal that the government wanted to achieve, and fundamentally, what is the tax package that followed the law on digital assets and this new regulation. So, what I'm going to first deal with is the introduction into the concept of digital assets as defined by the new Serbian legislation. What were the goals that the government wanted to achieve, and also I'll show you some elements that will then make more sense with respect to the tax questions that we may have, and what were the goals that were intended to be achieved by tax incentives and tax provisions that were introduced. So first of all, what Serbia is facing, as well as the entire planet, is basically the tokenization of the global economy. That tokenization is related to decentralization independence. Actually, this independence, or some would say covert nature of cryptocurrencies and digital tokens, was one of the good examples that we have for this is actually that the first official body in Serbia that had to deal with the legal nature of cryptocurrencies was actually the Special Court for Organized Crime, because in one big drug bust, the Serbian police managed to get hold of, in addition to illegal substances, to get hold of a large amount of cryptocurrencies. This actually happened almost some 6 or 7 years ago. Now, the problem that was also facing Serbia in 2020 with the COVID crisis is that we as a country are heavily dependent on direct foreign investment for our economic growth. And with the COVID crisis, there was a potential danger, which still luckily did not occur, that some of the investment flows would actually slow down. So what the line of thinking was basically, let's try to find as many as lines of capital as possible. And what was discovered was that in relation to digital assets, it was estimated that Serbian individuals, primarily individuals, but Serbian taxpayers, were holding around €500 million in cryptocurrencies, primarily cryptocurrencies. The relying on the possibilities of digital assets, on tokenization, was something which could actually help, especially Serbian small and medium-sized businesses, to find new lines of financing. So these two interests, primarily to activate another channel of investment, to lure those individuals who were keeping their assets in crypto to release this and invest the proceeds into the Serbian economy as soon as possible, as well as to create new channels of financing for the Serbian economy, was something which was driving the government to prepare and table the digital assets law. It was enacted by Parliament in 2020, and it came into force as of 30th of June 2021. But these were the two main goals which were behind the introduction of this very ambitious law, which actually provides Serbia with a framework, a solid framework, which is lacking in most jurisdictions because this is a relatively novel field. When it comes to digital assets, what the law on digital assets, and this is something which is quite relevant from a tax perspective, it divides digital assets into two types of digital assets, into virtual currencies, digital currencies, and digital tokens. And it recognizes that it is completely possible that a single form of digital assets maintains features of both of these forms, so that one and the same digital assets can be at a certain point in time a cryptocurrency, and at a different point in time a digital token. The National Bank of Serbia was given authority to supervise virtual currencies, so digital assets that are not issued or guaranteed by a central bank or a public authority, not necessarily attached to a legal tender. does not have the status, the legal status of money or a currency, but is accepted by national legal persons as a means of exchange that can be bought, sold, exchanged, transferred, and stored electronically. When it comes to digital tokens, the law recognizes three types of digital tokens: utility tokens, investment tokens, and tokenized assets. And it gives the supervisory authority over these to the Securities Commission, wherein if a specific digital asset shares characteristics of both a virtual currency and a digital token, the supervisory authority is divided between the National Bank of Serbia and the Securities Commission. Of course, at this point in time, the most prevalent form of digital assets in Serbia, as well as on the planet, are cryptocurrencies. But we have seen, especially in the field of utility tokens, the beginning of their introduction into the Serbian economic life. We already have examples of those being issued several years ago. And of course, investment tokens are something which is heavily being looked upon as a new line of financing. What the digital assets law effectively regulates actually are service providers, gatekeepers, and it defines in details what are the types of services relating to digital assets. There are 9 types of services: reception and transmission and execution of orders relating to the purchase and sale of digital assets on behalf of third parties, purchase and sale of digital assets for cash or scriptural money or e-money, exchange of digital assets for other digital assets, custody, safekeeping, and administration of digital assets on behalf of digital asset users and related services pertaining to the issuing, offering, and placing of digital assets on a firm commitment basis, underwriting, or without a firm commitment basis, maintaining a register of pledges on digital assets, acceptance transfer services, portfolio management. So all of these are listed as services relating to digital assets. And why this is relevant? It is relevant because in order for an entity to perform these services, you are required to obtain a license from the relevant supervisory authority. Now, the supervisory authorities are the National Bank of Serbia and the Securities Commission. At certain times, it will be one or the other. Sometimes it will have to be both. And there is a set of requirements for licensing service providers, wherein the requirements are quite close to what you will find in the financial services sector, with minimum capital requirements, with the proof of origin of capital, clean business records, specific conditions which need to be met by the employees and by the management of the service provider. What the law does not deal with, so the digital assets law does not deal with digital asset mining. This is not regulated, and a natural or a legal person can pursue the activity of digital assets mining freely. Now, if the issuing of a digital asset is to take place in Serbia, the issuer has to comply with the regulation which is in Serbia, primarily the digital assets law. What the law stipulates is that if you are to offer a digital asset on the market, it usually has to be accompanied by a white paper. Now, to be more precise, if you are to advertise your offer, then you need to have an approved white paper by the competent authority. And the digital assets law provides for the detail of the procedures for issuing and the approval of the white paper. With respect to investment tokens, the law recognizes the fact that crowdfunding is one of the activities which is becoming more prevalent on capital markets. And if we look at Serbian practice, this is already being done. The law provides for a possibility to actually enter capital markets through crowdfunding activities and this is something which can be quite interesting for especially small and medium-sized enterprises, those enterprises that cannot afford to participate in the regular capital markets, wherein which just can't afford this to attract capital on them. The law issues procedures and requirements for the issue of investment tokens. This is considerably easier than for securities issuance. And what the law limits is that securities in the form of digital tokens cannot have the features of shares or be exchangeable for shares. And the maximum value of securities to be issued by a single issuer in a 12-month period may not exceed 3 million euros. That's the limitation. Secondary trading in digital assets is allowed, regardless of whether the digital asset was issued in Serbia or abroad. Usually, this is performed by agents such as crypto exchange offices or cryptocurrency markets. But this is relevant only from the position that now, with the service providers being regulated, access to information may become far easier for the Serbian authorities. What the law does not allow is the use of digital assets for direct payment in retail. So this is prohibited explicitly in order to protect the current function of our official tender, the Serbian dinar. Under the law, legal persons can invest into digital assets and may sell or exchange them freely. There is a restriction now. From my perspective, this is something which I think is, as in any law, when you enact it and then when there are several interested parties, essentially what happens is that you have to compromise. So there was a discussion, a very, very serious discussion as to whether or not to allow the investment of digital assets into the capital of legal persons, particularly as digital assets have this volatile nature and their value sometimes can be quite volatile and sometimes can be quite difficult to appraise. Especially in cases where there is no free and global market for a digital asset. Now, what was done was that what was allowed was that digital tokens can be invested into the capital of a Serbian legal entity, provided that the token is on a list approved by the Securities Commission. But you can't do this with cryptocurrencies, which is, of course, a little bit strange because cryptocurrencies are actually far more easier to appraise and actually have developed global markets where value can be ascertained with surety. And for digital tokens, this is not the case. But this is something which has been which the law stipulates, and as you will see, this has impacted the design of certain investments which were introduced into Serbian tax legislation. Legal persons who do not use agency but trade in virtual currency directly on their own have to report these operations to the National Bank of Serbia. Now, this is the basics of the digital assets legislation that was introduced in Serbia and that is in force as of 30th of June 2021. Now, when the working group was preparing the digital assets law, there was a party which was instructed to prepare measures, tax measures, in order to enable this law to achieve its goal. And remember, that's the release of capital that is being kept in digital assets into the Serbian economy and easing of actually the whole environment for digital assets. So what I will do with you first is I'll show you what was the situation before the most recent amendments to tax legislation and what has been introduced, so you can see what are the actual changes that happened and what are the open issues, because we still have some issues that will have to be resolved. So the first issue that was on the table was actually the VAT treatment of digital assets, and this is something which does not arise, I don't know, in the United States as an issue, but this is a very much a European issue, and an issue in all countries that have value-added taxation or a GST tax. So what happened is that in 2017, a taxpayer tabled a request for an opinion of the Serbian Ministry of Finance, asking them, should I pay VAT on the sale of bitcoins? And the Serbian Ministry of Finance replied, basically saying, since the digital currency is not a legal tender, and the provision of the VAT law stipulating exemption without the right to deduct input VAT relates only to legal tenders, it cannot be applied to bitcoins. Therefore, trade in cryptocurrency is subject to VAT in Serbia. Now, the same conclusion was reached by other tax administration, but far prior to what happened in Serbia, a similar conclusion was made by the Swedish tax administration, and then this case went to the European Court of Justice, because it has competence in adjudicating cases which relate to European legislation such as the VAT directive. And in a case from the 22nd October 2015, it's a Swedish case. It came out of Swedish practice. The European Court of Justice said the opposite from what the Serbian Ministry of Finance said. It said basically that the same rule that applies to legal tenders should apply to digital currencies. In other words, their VAT treatment should be identical. So we had a problem in Serbia because since 2013, the opinions of the Serbian Ministry of Finance are binding for the tax administration, and the problem was that basically the VAT treatment that we would impose was different to anything that would happen in Europe, and it's not beneficial. So this could be a huge obstacle to the creation of a digital assets market. So this was the first obstacle in what we had before. Second of all, when we come to the personal income tax law, and remember I said this in the beginning of the presentation, in Serbia, the vast majority of cryptocurrencies is owned by individuals directly. So they're not in the hands of legal entities. From the perspective of personal income tax law, basically income from the sale of cryptocurrencies was taxed at probably the most unbeneficial. It had the worst possible treatment. It was treated as other income and was subject to the highest marginal tax rate plus a subsequent coverage by the complementary annual personal income tax and a possible application of mandatory social security contributions. And for the purposes and the self-employment income or entrepreneurial income treatment, which is more beneficial, would, for example, be interesting in the case of those who were involved in the activities of mining or digital assets trading. This was possible only if you were a registered entrepreneur, and when you were performing these activities within your registered entrepreneurship, which was usually not the case. And there is a reason for this, why this was not the case, which then entered into the reason being, and I'll explain to you this immediately, is that the biggest cost element in mining is the cost of energy, the cost of electricity. In case of Serbia, the cost of electricity for individuals is still subsidized by the government. So it is far more economic for you to mine within an unregistered business, because then you would be paying a far lower, if you were paying at all. We have examples of the avoidance of payment of electricity totally. Then you would be paying a far lower electricity bill than you would if you register as an entrepreneur and then mined within this activity. From the corporate income tax law perspective, general rules would apply. So a 15% tax rate on corporate income resulting from the trade or transactions in digital assets. But the biggest problem with respect to corporate income tax law, as well as the treatment of entrepreneurial income for those who kept business records, who kept books, is the insufficiently clarified accounting treatment of valuation and bookkeeping of digital assets transactions. This is something which is a global problem, so it was here in Serbia as well. So when you look at it, what was there before these amendments that I'm going to now talk about were introduced, there was a threefold problem. There was a big issue at the level of VAT, because of the opinion of the Serbian Ministry of Finance from 2017 saying, yes, VAT applies to transactions in cryptocurrencies, which was contrary to the practice of the European Court of Justice and thus the practice in virtually all European countries. Second of all, there was a very unfavorable treatment at the level of personal income tax law. And at the level of corporate income tax law, there was a general uncleared accounting treatment, which was an issue. So, when small countries such as Serbia try to regulate certain issues that are of this nature, what we usually do is we don't try to come up with something new. What we usually like to do is to find a very solid comparative example and then basically copy it. That's something that is usually common sense, and then because then we rely on those who already had past experiences. The problem with digital assets is that from a tax perspective, most rules relating to the taxation of digital assets that are applied globally are contained in non-binding instructions and interpretations. Very few countries actually introduced into their legislations firm rules on the taxation of digital assets. This is something which is not common at all. Take, for example, Germany or other large European countries. South Korea, even one of the countries at the forefront of this new technological revolution. Basically, the tax administrations and governments have been wary of introducing clear-cut rules into their legislation, relying on general principles mostly, and waiting to see basically what are the experiences of their peers to find best practices. So what we had to do is actually we had to come up with some new solutions at the level of a country such as Serbia and make our own decisions. Of course, to reiterate, the goal was to provide a taxation framework to enable a more favorable treatment of digital assets and to encourage taxpayers who own digital assets to release them and invest them into the Serbian economy, where fresh capital was and is always greatly needed. So what was the first step? The first step was, of course, VAT. And the dilemma was whether to issue a new opinion or to actually amend the VAT law itself. And the decision was made, I think, a quite appropriate one, to amend the VAT law itself, basically to resolve any potential open issues of legal uncertainty. So this was actually done. There is a new provision, explicit provision in Serbian VAT law. Now the problem was there was a dilemma whether to introduce a general provision or actually to introduce a rule applying only to digital currencies. Now this again, for those who actually who are from the digital asset world, probably this dilemma seems to be a little bit strange, because in the beginning of this presentation, we already talked about the fact that digital assets have this hybrid nature and can at one point be, depending on how you see them, how you use them, what you intend to do with them, at one point they can be a cryptocurrency, and then on the next day they can be a utility token, for example. Now, So this dividing line between tokens and currencies is not actually it's not straightforward. It's complex. So there were good arguments, and I would personally be in favor of that, but my view was not accepted, to have a general rule applying to all digital assets. However, again, I told you that countries like to follow and like to apply well-established best practices, and they are wary of going into the unknown alone. So, because we had an explicit case law from the European Court of Justice that was sadly dealing only with cryptocurrencies and not with all digital assets, the Serbian legislator came out with a rule which deals explicitly with the VAT treatment of cryptocurrencies, virtual currencies. But this leaves us with an open issue on the VAT treatment of other forms of digital assets. One of the reasons why this can be interesting is especially in case of utility tokens, where there is an underlying service provision which would in any eventuality be subject to VAT. So the issue arises, when does the VAT obligate when does VAT arise? When are you obliged to assess VAT? So this is something which will be an open issue and will have to be dealt in the future. That is the VAT treatment of utility tokens, especially because VAT issues are far less present in the case of investment tokens, but are essential when it comes to utility tokens. So when it comes to VAT, there is a very clear rule regarding cryptocurrency. So when you have something which is clearly a cryptocurrency, as for example a Bitcoin, yes, there is a very clear-cut VAT rule, and there is no dilemma as to its VAT treatment. When it comes to utility tokens, this is not the case. Now, when it comes to corporate income tax, what was done basically was to shift the tax treatment of the proceeds from the sale of digital assets from general treatment to capital gains treatment. So the same treatment that would be accorded to gains from the sales of securities and shares. And some clarification as to the accounting treatment was introduced. I'll talk about that a little bit later. What was introduced into the following this shift from general taxation rules to capital gains taxation, a rule was introduced, a new article, Article 30B of the corporate income tax law, which basically tells you the following: capital gains generated by sales of digital assets are not included into the tax base, so you don't pay capital gains taxation to capital gains tax on capital gain that you generate on the sale of digital assets, provided that the money you generate on such a sale you invest in the same taxation period into the base capital of a Serbian resident corporate taxpayer or Serbian investment fund set under Serbian law, whose primary center of business and investment activities is located in Serbia. What does that mean? It means that if a legal entity purchases bitcoins for 100 and then sells them after a certain period of time for 300, you have a capital gain of 200 that would generally be subject to a 15% corporate income tax. But if you invest the proceeds from the sale, if you invest them in the same taxation period into the capital of a Serbian resident company or a Serbian established investment fund, provided that the company or the investment fund primarily do business, or that does when we say do business, is that their production lines are here, most of their employees are here, or most of their investment is performed here, then you get a complete 100% tax relief. You don't have to pay tax on this. on such capital gains. And this is in line with the goal of activating the capital that's in digital assets right now, and investing this capital into the Serbian economy. So if you sell and the proceeds from the sale are invested into a new Serbian business, essentially you don't pay capital gains tax, provided that the seller in this case is a legal entity. Now, when it comes to the personal income tax law, the following changes have been made. First of all, there is now a clear rule stating that the income from the sale of digital assets is taxable as a capital gain, which provides you with a one-off 15% tax burden. You don't pay complementary annual personal income tax on this. There is no mandatory social security contributions on this. So essentially, if you if you invest into digital assets as an individual, the only tax burden on the capital gains which may arise from these investments is a 15% one-off tax rate, and that is it. You don't pay anything in addition to this. If you actually register as an entrepreneur, then general rules for entrepreneurial income apply to you. So there were no changes here except for the clarification with respect to the accounting treatment. Now, there is a problem here. And the problem was that a large amount of cryptocurrencies held by Serbian individuals actually were a large amount of these these assets were generated by virtue of mining, mostly unregistered mining. And I told you that the reason why this was done through unregistered mining was predominantly to avoid paying electricity at a higher rate. But we also know that there's a huge amount. The estimation is around 500 million of such assets in the hands of Serbian individuals. So the issue was what to do with this, how to stimulate these people to essentially activate this capital, to come out with it, because if you were mining in an unregistered fashion, you can't really show any cost basis for your asset. You can't prove what were the costs of their acquisition because you were not keeping records. That was the whole point. So the 15% tax rate would fall on the entire amount of at which you would sell the digital asset that you held, because your basis would be zero in this respect. So this is what was introduced after actually discussion with industry, with representatives of those who actually were mining. And Article 79A was introduced into the Serbian personal income tax law, which states a taxpayer who within a time frame of 90 days invests the proceeds from the sale of digital assets into the base capital of a resident company or into the capital of an investment fund established under the legislation governing investment funds, so basically an investment fund established under Serbian law, whose center of business and investment activities is located in the territory of Serbia, again, the same condition as in the case of legal entities, is exempt from capital gains tax in the amount of 50%, with a refund if you invest in a time frame longer than 90 days but shorter than 12 months, starting from the day of sale of respective digital assets. So essentially, what you have is that if you were mining and you never register as an entrepreneur and you can't prove your cost basis, and now you sell your digital assets, the effective tax rate that you would fall under is 7.5% on the total amount of the proceeds from the sale. So if you sell for 100, your tax burden would be 7.5. The additional condition is that the company into whose base capital you invest, it cannot reduce its base capital in the year in which the investment has been made, as well as in the following 2 calendar years, which means that essentially this needs to be a solid and relatively mid-term investment. You can't just run money through a capital through a company, lower capital, and then pay the proceeds back to yourself without tax. And the basically this capital needs to actually be employed within the economy. So this is something that's been introduced into the personal income tax law to actually make the treatment more favorable. Why is there a 50% and not 100% alleviation? Well, that is to account for the use of the lower the illegitimate use of lower electricity prices by those who were mining in an unregistered fashion. The open issue, and that's what we are going to close the presentation, then it will open for questions. What we have as an open issue everywhere on the planet is the accounting treatment of digital assets. Now in Serbia, what we apply as our law are actually international accounting standards, IAS, and international financial reporting standards. And at this point in time, neither of those have any special rules on accounting and reporting of digital assets. The IFRS board is examining the issue, and it did provide some initial guidance with respect to the accounting treatment of digital assets. But what we are expecting is actually to, in the future, have amendments to them to specifically deal with this area which is growing in relevance. But sadly, what we are left with is interpretation of general rules which don't have any specifics on digital assets themselves. In Serbia, we have an accounting law, a law on accounting, and its articles 23 to 26 stipulate that basically what I just told you, that we implement IFRS and IAS into our own legislation with some small exemptions. Realizing that the accounting treatment is going to be a problem, in February of 2021, the Serbian Ministry of Finance issued an explanation related to accounting recognition, valuation, and mode of accounting of digital assets in business records, providing some guidance. What is stated in this clarification is that virtual currencies fall under the definition of intangible assets under IAS 38. When they are kept with the intention of further sale in the ordinary course of business, what applies to them is IAS dealing with inventories, IAS 2. But this standard is not applied to commodity brokers and dealers who measure the inventories at fair value and where the fair value is recorded under profit loss in the period in which it takes place. And this is the clarification that we are provided at this point, so we know in Serbia which accounting standards to apply, well, under the explanation and guidance provided by the Ministry of Finance in February 2021. So this is the situation that is currently in Serbia from a tax perspective with respect to digital assets. And now that I have completed the presentation, we can open up the Q&A session if you agree.